So the rules for accounting changes and correction of accounting errors, it's going to depend on what type of change, or if it's an error, if it's a change in principle, change in estimate, or reporting entity. So what do these things mean? How do you handle the changes? Well, there could be a retrospective approach, meaning as of today, I have to go back and restate my comparative years to the earliest comparative year, the beginning retained earnings. Or it could be a prospective approach, meaning as of today, I don't have to go back. I just start with my change today and move forward. In general, changes in accounting principle are handled retrospectively. Most of the time, there is an exception. Changes in accounting estimate are always handled pro. Change in reporting entity, those are always retro. Those are the rules, those are the main rules. And an error, well, it's going to depend on when you find it. Did I make the mistake this year, or did I make the mistake last year? So when are accounting principle changes allowed? Well, it could be required by GAAP, a mandated change, or it could just be suggested by GAAP, meaning it's a voluntary change, or there could be another principle will more fairly present your information, so you decide to make a voluntary change. Now, this cannot be an arbitrary decision. You have to justify the change in the disclosures, and of course, be able to justify it to your auditors. So for retrospective approach, most changes in accounting principle. And that would be if you go from change in inventory costing method, LIFO to FIFO, or the completed contract to the percentage of completion method. Those are different revenue recognition methods studied in the revenue recognition chapter. If you make a change from US GAAP to IFRS, you've got to explain why, and you've got to make a retrospective change. So looking at difference between a voluntary and a mandated change. So if it's voluntary, if it's your company, you decide to do it, then you have to do it retro. You restate or adjust your retained earnings of the earliest year on comparative financial statements presented. So what does that mean? Let's say you show 3 years of balance sheets. So really you're going to have to go back and do the math 4 years, because if you need to adjust retained earnings for the beginning year 3 years ago, you're going to have to know what happened in year 4 going back to make that adjustment. If it's mandated, if FASB says all companies have to make this change, but because we're making you do it, you then have a choice. FASB, of course, would prefer the retro, but because of the mandate, because you have to make the change, it's not voluntary, you have an option. You can do it pro if it's not cost effective to do retro. But you've got to be able to explain why you came up with that decision, that there is a cost effectiveness constraint. There are many disclosures required, whether it's voluntary or mandated. And looking at a comparative balance sheet going back 2013, 2012, 2011, you would have to restate retained earnings of the earliest year, the beginning year. So really, how do you get that number? You're going to have to go back and the prior year. Recalculate net income in 2010 as if the principal had been used that year. Determine what the 2010 ending retained earnings would have been to restate the beginning retained earnings. Now, a prospective change in estimate. This is an exception to change in principle. A prospective approach to a principal change, you handle the same way as a change in estimate, or just the traditional, what is an estimate? Depreciation, warranties, though that's an estimate. Any change in depreciation methods is a principal change that is indistinguishable from a change in estimate. So it's not technically not a change in estimate. It is a change in principle, but you handle it like an estimate. The other exception is if you were to change from any other method to LIFO, the beginning LIFO is too complicated to calculate because of all the inventory layers. And those inventory layers we will talk about in the inventory chapters. So LIFO to FIFO must be handled retro, but the other way around, FIFO to LIFO, that's the exception to the rule where it's too difficult to calculate, so you're allowed to do it pro. Now, a prospective approach for a change in estimate could have a change in estimated useful life, in salvage or residual value, could have a change in bad debt allowance, change in warranty expense for different reasons. Those are your changes in estimates. Now, the third one, change in reporting entity. This is required to be retro. And this would be a corporate merger, a change in a FASB rule for corporations reported as separate entities. So let's say I have a company and I have 5 subsidiaries, and those 5 subsidiaries are all reported separately. But a change happened and FASB is requiring me to consolidate now, or maybe I now have gone beyond significant influence with an investment in another company. Now I have control. I'm required to consolidate. That is a change in reporting entity. And it's handled the same as a change in accounting principle. It's retro. So correction of accounting errors. It depends on when you find it. If you make the mistake this year and you find it this year, you just fix it. You do an adjusting journal entry or a correcting journal entry. Closing has not occurred, so there is nothing to go back and restate. But remember temporary and permanent accounts. If you made the mistake last year or longer ago in a prior year, it's handled virtually the same as an accounting principle change because your income has closed to equity. So you've got to go back and restate the prior year financial statements. All right, now, let's say I have a company, and small company, and I've been using the cash basis. But my company grows, and I think that I probably should change to follow GAAP rules. So I'm going to go from cash basis to GAAP accrual basis. What type of correction is this? Is it a change in accounting principle, an estimate, an entity, or is it an error? Well, cash basis is not GAAP, so technically you were doing things wrong all along. So changing to GAAP is correction of an error. GAAP to GAAP, that is accounting principles change. A non-GAAP to GAAP, that is an error correction. So again, to summarize, change in accounting principle, retro most of the time. Estimate is pro all the time. And entity is retro all of the time. Error correction, it depends on when you find it, how you're going to handle it.